Good morning, I'm Angie Austin with Oil and Gas 360, and we're here at the 2015 Enercom Oil and Gas Conference in Denver, the 20th year of the conference, and we're being joined this morning by Brian Schmidt. He is the president and CEO of Tamarack Valley Energy. Good morning, Brian.
Good morning.
All right, so you've been here before to the conference. You've been coming for a few years. You come down from Canada, so our weather obviously agreeing with you today. We hit a record low. Did you know that?
I did not know that. It seemed the same as Calgary. So.
Oh, did it? The Texans, though, I think are in a bit of a shock this morning with the cold weather.
Yeah.
All right, so let's talk a little bit about what you get out of coming to the conference.
Well, I think this is there's a few good reasons why we're here. This is a great introduction for our company in front of American investors. Typically, we don't see our funding comes out of Toronto, Montreal, but so this is a great venue for us to come. It's also one of the first events that happens after a fairly quiet summer season when a lot of the investment community takes vacation. So this is a refreshing conference to come to. I find the energy quite exhilarating here, despite what's happening with commodity prices. So we'll probably be back next year.
Yeah. All right, you and I had a discussion yesterday. We were chit-chatting for a while, and you were talking to me specifically about an interesting topic that I found interesting, about the difference between operations in Canada and the U.S.
Absolutely. Despite the oil price and what's going on with oil price, there's also a lot of currency volatility. So investors, when they're making decisions about should they invest in the U.S., should they invest in resource sector in Canada, we've seen our dollar go from almost at par down to around the 75 cents. So really, if you're an American investor investing in Canada, we're a bargain right now. You're getting a 25% reduction in the cost of getting our reserves in Canada. So I think it's a great opportunity. The last time we had this kind of currency difference, there also was a lot of American investments started to come into Canada at that time. When you combine that with typically lower royalties, that generates rates of return that are very good, even at today's prices.
Excellent. Well, let's get into some of the more in-depth questions, Brian. Tamarack Valley announced 2Q estimated production of 6,992 barrels of oil equivalent per day, and you've reconfirmed your guidance of 8,000 to 8,200 BOE per day for 2015. So where is the production coming from primarily?
Yeah, so you can see decent production growth there, despite what a down environment's looking like. Most of the production is coming out of the Wilson Creek area. So I think, like every company, you're rationalizing your plays. You're trying to figure out which ones work at today's prices, and you're trying to figure out where you can make the biggest impact on cutting costs. So most of this is coming out of Wilson Creek. About 90% of the new production will be coming out of Wilson Creek. 60% of our current production it comes out of Wilson Creek. There's also some growth occurring in the Hatton area of Saskatchewan.
All right, let's talk a little bit more about Wilson Creek in particular. Tamarack recently completed a $53 million tuck-in acquisition at Wilson Creek. What did you acquire, and how does this acquisition work into your ongoing operations?
Yeah, so if you go back to last year at this conference, we had 10 sections in Wilson Creek. We did a $168 million acquisition of the Suncor in Wilson Creek area, and then we followed that up by the $53 million acquisition that you're referring to now. So we've significantly increased our presence in an area where we're getting the best rates of return, some of the best rates of return in the basin. That acquisition, the integration of those acquisitions is key. That's actually not one acquisition in the spring, it's actually three one-off negotiated. They were not auctions, and we put those pieces together in and around our existing operations. The synergy comes from the following. Number one, there's about 220 kilometers or 120 miles of pipeline that comes with it, a gas processing plant, 3 oil batteries. That's all facilities that we don't have to build now in order to bring our existing land base on production. So we're going to be able to put more of our cash flow to the drill bit instead of facilities. The other thing is, now that we've got one large contiguous block, we can drill wells that are 1.5 miles long instead of 1 mile. We can cross the boundary that had different working interest owners. All the working interest ownership got cleaned up in this transaction such that we can get wells that used to be 1.5 year payback at current strip prices. Now we got some wells that the 1.5 mile wells that are 1 year payback at current prices.
All right, now let's talk a little bit more about operating costs in Wilson Creek. I understand they're down 55% from mid-2014 levels. Could you break out where the savings came from?
Absolutely. So when we acquired the asset last year from Suncor, there were about there were a number of staff in there. Obviously, any good company that's operating in this environment is making difficult decisions, and we had to make the difficult decision of staff count. We reduced the staff from 15 people down to 5. That's probably the biggest component of operating cost savings. We reduced chemical costs as well. We reduced things like road maintenance. There probably isn't a stone unturned. That operating cost savings then goes from about $17.40 a barrel down to $8 a barrel. Now imagine running your well economics now with $8 a barrel instead of 17, and that's the biggest reason we're able to maintain our 1.5 year payback is that operating cost cut.
Interesting. All right, recent studies identified Tamarack as achieving returns in the top 10% in Western Canada, something to be proud of. Talk about your rates of return.
Yeah, so the Cardium is one of the top plays in Canada, and we happen to have some of the best, the highest quality acreage in that play. So combine that with a 20% capital cost reduction, which we've achieved since last year on the capital side, and the 50% operating costs that we've achieved, and that's how you're going to build a company to survive and thrive in this environment.
All right, we talked a little bit about acquisitions earlier that you've made. Let's talk about, are you looking at additional acquisitions at this time?
Yeah, so if you look at what we've done there, investors want to invest in companies that have, they know they're going to be around, they trust them, and they get that kind of sustainability from these quick payback wells. So we'll be looking to add to that, add to the position in there. We have a fair bit of room on our bank lines, $165 million lending, and at the end of Q2 we're about 97. So we have quite a bit of room on our bank line to act on transactions, but we're fairly picky about how we put them on the table. So they have to be strategic, number one. The guys have to be able to see at least a double in production. It has to be good value relative to our internal valuation at conservative prices. And lastly, it has to be accretive to shareholders, and that's probably last one's probably the most important, to make sure that through a transaction, our existing shareholders are winning.
Well, in our discussions the last few days, Brian, I've sensed your enthusiasm about the business, your excitement about being here at the conference. Has this, you obviously have a passion for your work. Is this something you'd always planned on getting into? How did you get into oil and gas? I'm curious.
Well, yeah, I've been around oil and gas in a rural community, and I just find the business is, I would advise this career in this for all three of my kids are in oil and gas.
Really?
And I just think it's so exciting. And say what you will about downsides and what we see right now in the current cycle, but if you're well disciplined and you do a good job and you work on your cost structure and you're a low cost producer, there's a lot of companies are going to win out of this. And so I think that dynamic and the oil business, I think, is really exciting.
Well, what if you had a crystal ball, what would you see for 2016? What is your hope as a company? I mean, I'm sure an upturn, but realistically, what are you kind of thinking may happen?
Well, first of all, let me tell you, we're about 70% of our crude is hedged. So we've got some good protection financial instruments in place to give us good rates of return. But I think longer term, you really can't rely on financial instruments to grow your business. So I'm really looking in 2016 to continue to work cost structure down and make sure that we can maintain that rate of return on our wells at 1 to 1.5 year payback. I don't know of any other strategy that works other than making sure that at the end of the day, they're the lowest cost producer and you're putting your product on cheaper than anybody else.
Right. It comes down to the basics, doesn't it?
Yes,
Even though
it
it's
sure
hard
does.
to get there, it comes down to the basics. Well, thanks, Brian. I've enjoyed speaking with you the last few days.
All right. Thank you
All
very
right.
much.
I'm Angie Austin with Oil and Gas 360 here at the 2015 Entercom Oil and Gas Conference in Denver, the 20th year. And we just conducted our interview with Brian Schmidt, the president and CEO of Tamarack Valley Energy. Thank you, Brian.